Hello, I'm James Yardley, and today I'm joined by James Mahon, the manager of the SVS Church House Tenax Absolute Return Strategies Fund. James, thank you very much for joining us today.
Pleasure, thank you.
James, there's a lot going on in the world at the moment, so can you help us understand the current investing environment and what investors are thinking about?
Yes, indeed, there is a lot going on in the world. Central bank actions are really the key to this at the moment, I think. They do appear having really done a cracking good job in April 2020 when they came into the markets to support and bring order back, which I think was probably central banks at their finest. Since then, it's perhaps not been so impressive, and certainly over the course of the last 6 or 9 months, they have got very much behind the curve, as the expression goes at the moment. It is unfortunate that they persisted with the idea that inflation was going to be transient and therefore kept pushing so much money into the economy or into the world economies. And that means that their about turn that has really sort of taken strength or gathered strength over the last few months has really come as a bit of a shock. And we're now seeing, particularly the US Federal Reserve and the Bank of England, making really quite aggressive noises on the tightening that they're going to put in place. Obviously, they are withdrawing the monetary support in terms of actually buying government bonds and buying corporate bonds to actually put cash into the markets, but also they're putting interest rates up. And it looks as if this is going to be carrying on for the rest of the year. It's quite a significant change because right into late autumn and winter, it was still the central banks were still maintaining that they would be keeping rates low for a lot longer than we all thought, and that the inflation was going to stay low. And clearly this has wrong-footed them, and we've started moving rates up, and we can expect them to move up quite a lot more this year. And that has been a significant change to the market backdrop.
And you said recently, though, that rising rates might actually be a good thing. Can you explain that a bit more?
Yes, I was really referring to, if you like, the hope that this might be a sign that we would be returning to normal. Not really sure that I can define normal, but the idea that we could get rates back away from emergency measures strikes me as a good one. And it's obviously this rates have been at very artificially low levels, but in fact, the banks have been operating since the global financial crisis. So there really is a lot of scope for them to stand back and let their balance sheets shrink because they've bought so many assets that they don't really want to own. So it would be very nice to see rates back at slightly higher levels than they have been. I think one could also suggest that perhaps it's not a subject for today, but one could also suggest that it would be nice to see a bit more balance between borrowers and savers. And borrowers have obviously had it extremely good for the last little while, whereas savers have had a rather raw deal.
Yes, absolutely. And your fund, of course, is a multi-asset fund. So what sort of moves have you been making in the recent months to sort of react to this change in rising yields and the sort of rotation we've seen away from growth stocks to value stocks? Have you made any big changes?
Yes, we have. As you say, this is an absolute return fund, and in particular, what we want to avoid is any big volatility. We don't indulge in hedging and shorting and these sort of practices. So it is all about how we actually place our assets, where we go with the assets. So the key thing to us was to get away from areas that would be unduly affected by increases in rates. In other words, we had to reduce our bond allocation, so our fixed interest allocation, and in particular, we had to reduce it's called the duration of it, so its life, if you like, how long until these bonds mature. So our principal...
Like how long your money's locked up for, essentially, isn't it? So you don't want to be locked up at a low interest rate when interest rates are going up. You want to get your money back sooner so you can reinvest at those higher rates.
Exactly so. And the principal weapon that we use is to move away from, quotes, fixed interest securities that pay a fixed rate to ones that pay a floating interest rate. As if the interest rate goes up with interest rates in the market, then the capital is protected, because in a fixed interest bond, as you were just explaining, the capital value of the bond will fall as interest rates go up. So to avoid that, we moved up to 40% of the portfolio into bonds that are called floating rate notes, but it simply means that the interest rates move up as interest rates in the market move up, so the capital value is protected. That's been our principal move. You also asked, I think, about growth and value. Here I perhaps sound a note of caution. There's been a lot of talk about a big shift out of growth and into value, and we saw, or particularly in the latter part of last year, beginning of this year, a big shift out of some of those very highly rated, particularly US technology stocks. Goldman Sachs produces an index that they rather charmingly call the index of non-profitable tech stocks. And that, in fact, halved over the course of the past year, almost without people noticing. And obviously, we've seen what's happened to the likes of Bitcoin. And then more recently, we've had a number of the previous darlings, if you like Netflix came off with a very big bump. And then companies like Peloton and a number of these other non-profitable stocks, or stocks that really were rated as if growth was going on forever, have come off really very significantly. So yes, there has been a shift away from those growth stocks, but I wouldn't want to tar all good companies with that same brush, because a lot of those stocks that we've been talking about were simply too highly rated, and they were in bubble territory. But the switch, if you like, from all, quotes, growth to all value, I'd be very wary of, because value in this context seems to mean anything from tobacco companies, oil stocks, mining stocks, banks, all sorts, and out of lots of very good companies. And I would treat that with a great deal of caution. A number of these stocks are very cyclical. I don't wish to own tobacco stocks. I don't actually wish to own oil stocks. Of course, oil stocks are booming at the moment because of the jump in oil prices, but I don't think they're at all a satisfactory long-term investment. And so I think that a lot more balance is required, and there are some areas of value. Some of the UK banks, for example, and some of the UK insurers do still represent value and should benefit from rising rates. So that's an area of value that I think is still correct. But a lot of very good growth companies, as I point a few things like Diageo or Croda or other such well-known companies, have been very significantly derated. So prices have fallen quite sharply. And those, I think, now represent extremely good value in their own right. I'm possibly going around in circles, but I think you see what I'm saying.
No, that's great. Well, James, thank you very much for your thoughts. Always very interesting. And if you'd like to know more about the SVS Church House 10x Absolute Return Strategies Fund, please visit chelseafs.co.uk.